Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're taking a look at portfolio construction, ripping up the old model of the efficient frontier with Robert Michaud of New Frontier Advisors. In today's podcast, we discuss what was wrong with the old way of doing things, how the Michaud system might be a better way of building a portfolio, and the use of ETFs in this technique too. So if you have any questions or comments, make sure to send them in to podcast@zacks.com, and don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Robert right after this. Okay, Robert, thanks for joining us today. I wanted to start off by talking about the first steps in portfolio construction. We've heard a lot about optimizing portfolios across this so-called efficient frontier, but it seems like this has fallen out of favor in recent years. Why do you think that is?
Well, Markowitz gave us a great theory, and it was the basis for much of modern finance. But unfortunately, it just didn't work in practice. So after decades of disappointing practice, performance that wasn't as well as people were hoping for, they had to find another way to build portfolios. And since many of these different portfolio construction techniques were either ad hoc or not really based in financial theory, it was really a setback for investment science.
So what do you think investors are missing out on when they just look at this efficient frontier? Is there, sort of a mistake that investors are making?
The efficient frontier should really be giving you a lot. For example, just the concept of efficiency. You're trying to maximize return and minimize risk for all sorts of different types of investors. You're trying to give diversification, which is an intelligent combination of assets, which is recognizing the complex structure of correlation between assets. And something that's important and often overlooked is optimization can design portfolios for an investment objective. So you're really building a conservative portfolio for conservative investors or an aggressive portfolio for aggressive investors, or having a real procedure and thought and rationale behind how to build a, say, tax-efficient portfolio rather than just deciding to have, they're tax-efficient investors, so we're just going to throw out all the other types of fixed income instruments and replace them with municipal bonds without having a real process for that. And then finally, you need sort of the right balance between risk and return among all the different risk factors and asset classes. And without optimization, there's really no way for a person to be able to successfully do all of these different objectives.
Yeah, maybe you can tell us a little bit about your process at New Frontier for optimizing these portfolios. What makes your process get over some of these hurdles that we see in the efficient frontiers?
Well, when we first started doing our research, we realized that there was the major deficiency of Markowitz optimization was that it assumed that you had perfect estimates of risk, return, correlations, everything that you need to understand how assets work together and then build an efficient portfolio of them. And if you actually do know all of those things, then Markowitz's theories are perfect. They all flow through. It really does a good job of describing investor behavior and building appropriate portfolios. But unfortunately, that's such a big assumption, and no one in finance really believes that they have a very accurate understanding of all of these different inputs. Generally, investors are just happy, not if they get the expected return correct out to several decimal places, but they're generally happy if the things that they thought were going to go up actually end up going up. So this big disconnect between the precision that the procedure requires and the actual precision that investors have just wasn't reasonable and what made Markowitz's optimization unworkable in practice. So what we did is we said, okay, so you don't have perfect estimates of risk and return, but you do have a good understanding of roughly what they're like, and you also understand how wrong you could be in various directions. And so we modeled this uncertainty, and we essentially build portfolios that are diversified across thousands of different ways that the future could work out rather than betting everything on having a precise knowledge of exactly the one way that the future will unfold. And so what you get is a much better diversified portfolio that's much more realistic, and instead of betting everything on one asset that worked well in the past, you have a portfolio that's more likely to perform well in the future. And so this is something that we wrote a book about, and we thought that this was an idea important enough to use as the basis for starting a new company.
So is it fair to say you guys look at basically every not every possible scenario, but almost every possible scenario, and you look for the best situation that's going to sort of fit in this entire frontier. Is that a quick assessment of your guys' strategy?
Yeah, well, clearly you can't think of every scenario, and
Sure.
you can't just enumerate them. You need computers to generate these and span all the possibilities. But yes, what's trying to happen is that you're picking a much better diversified portfolio that's going to be not the best one in any specific future scenario, but the best one on average, given that you don't know what the future is going to be.
Gotcha. And it seems like ETFs are a very important part of the actual portfolio construction. Is there a reason you guys went with ETFs as opposed to mutual funds or stocks or, anything else?
Well, most investors agree that the place that you have the biggest impact on portfolios' behavior and performance is through asset allocation. And so we felt like being able to use ETFs, which are transparent and you can actually do what they say, allows us to have the most power through asset allocation and not focus on all of these other picking portfolio managers or trying to pick stocks, which generally most studies show is likely to erode performance rather than help it. So by using ETFs, where you can understand the risks involved and exactly how each ETF is going to behave, allows you to have a much more precise control when building your whole portfolio. For example, even if we did want to do asset allocation with active managers, you don't have control over what each active manager is going to do. And it's kind of like driving around with loose bolts and things in your car. Things can wobble and move in different directions at a time when you don't necessarily want them to. So ETFs, I think, allow us to actually enhance performance due to that transparency.
Yeah, and I'm sure having active managers screws up your simulations where you don't know what they're going to do. So it seems like that's probably not a good strategy for you guys. So I'm guessing you guys mostly use index funds. Is that a fair assessment?
Yes. So you can get into a big debate over is there such a thing as a passive bond ETF or not. But we use ETFs where we understand how they're going to perform in different market situations.
So are there any minimums for volume or maximums for the cost of these ETFs that you look for? Like what are some of the criteria that you look at for the various funds?
Well, we're an independent manager, so we will use ETFs from all the different providers. We have quite a number from iShares and Vanguard, but also State Street Power Shares and others. But we will pick what we think is the most appropriate ETF to represent either the risk characteristics or the return premium that we are going for. And so that's the first most important thing is, does it represent its asset class in a way that we understand and in the way that we want? So we manage a fair amount of assets, so we do, of course, need to have sufficient liquidity in the ETFs that we're using. That can mean either the underlying instruments are liquid or the ETFs themselves are liquid if you're making a big trade. And expense ratios are, of course, important for us, but since we have the benefit of using an optimization process, we just put the expense ratio of the ETF as an explicit input into the process. So if there is a emerging markets bond fund that we use, for instance, now that might be more expensive than the typical ETF in our portfolio, but we include its expense ratio, and the optimizer will just say this has important diversification characteristics and other reasons for being in the portfolio, and it will find the optimal allocation of that particular ETF for each risk target. Whereas if it had a lower expense ratio, then maybe the optimizer would have wanted a little bit more.
Right. And looking at some of the examples you guys have for the portfolios, I'm noticing a big difference for the bond part of the portfolio in particular. I can see that, for example, a traditional portfolio might just have, short, intermediate, and long-term bonds, but you guys are breaking it down a lot more into various slices, be it high yield, mortgage-backed, international. Can you discuss why you think this is necessary to really break it down across these various subsections that go further in depth in the bond world?
Well, one thing is because we have the technology that allows us to take advantage of these things. So one way of thinking about investing and how investors are rewarded is through risk factors. And so if you have the major ones that people have heard about, things like small cap, value, a premium for emerging markets over developed markets. And on the fixed income side, the big ones are, of course, credit risk and duration. And so we want to be able to sort of span the spectrum of all of these different risk factors, because when we are building an optimized portfolio, we're balancing off risk and return across all of the ETFs in the portfolio for conservative investors and aggressive investors and everything in between. And so when we have a conservative portfolio, then we would like to be able to not just have more bonds in that portfolio, but be able to have the mix of bonds, and of course the stocks as well, be more appropriate for a conservative investor. So if you look inside, you will see in a conservative portfolio, you'll see a lot more of short treasuries and lower credit risk type of bonds in there. If you're looking on the stock side, you might see things like USMV or a low volatility ETF over there. And then as we get gradually more aggressive, we like to be able to have the specific ETFs that can offset some of the risks in the equity portion of our portfolio as well. So you might see more long treasuries, which have been very effective at mitigating some of the equity risks for the other things that we think are likely to contribute to return over time for an aggressive portfolio.
Yeah, I also wanted to ask, do you guys see a lot of turnover from either month to month or year to year in these strategies, or is it kind of built as a more long-term approach?
It's always a hard question to say whether this is a long-term approach or not, because we don't really think of a specific investment horizon. What our investment philosophy is that we are trying to invest in global economic growth. So we want to be globally diversified, we want to be invested in markets, and we want to be consistently invested in markets. So that means that we are not going to have a lot of turnover where we quickly switch all of our portfolios to cash. We're never going to favor one asset class to the exclusion of all others, because that would be highly speculative. And so it's more like, philosophically, a strategic portfolio with lower turnover. However, we do understand that the world evolves over time, and that you don't want to have the same portfolios with the same exposure that assumes that, for example, the correlation between international stocks and domestic stocks is the same today as it was 30 years ago, or that interest rates are the same today as they were in the past. These are things that need to be updated, and they do generate some turnover and certainly lack of a staticness in the portfolio, but it's relatively low. Our turnover has been something like 20% per year since 2004.
Yeah, and another aspect that I just thought of as you're talking, we've seen assets become more correlated over the past 10, 20 years here. Has that made your job a lot more difficult, or has that forced you guys to adjust your process at all in terms of picking different asset classes or different subsections in those various sectors?
Yeah, well, it's certainly been more of a challenge, but I think that's been good, at least made life more interesting, and I think we've been able to rise to the challenge, so I think it's been a positive. And there certainly have been a lot more ETFs for us to be investing in also over time. So these things have offset each other. So sure, a long time ago, diversification was simple, just add a little bit of international and you had plenty of diversification. Now that's an oversimplification, of course, but now it's a lot more complicated than that. And so I think you need a sophisticated process, a deep understanding of portfolio construction and optimization, as well as a good understanding of statistics and an ability to separate the true underlying signal of data from much of the noise that you get in the price changes and data.
Yeah, and speaking of the process, I see most of the model portfolios have between 15 to 25 ETFs in them. Is that level of diversification some sort of sweet spot that you guys have found? I mean, why not fewer ETFs or more in a particular portfolio?
We put a lot of effort into trying to pick the right number of ETFs in our portfolios. So there's a lot of good ETFs to choose from, and sometimes we're disappointed that we can't put more. But we actually do calculations and say, well, what is the marginal expected increase in terms of number of basis points we would get from adding one more ETF to our portfolio? And so we've pretty much hit the sweet spot, I would say, there where it's starting to get diminishing returns beyond where we are. I think our balanced portfolio has up to 27 ETFs in it right now. The other thing is sometimes there's a need for a new ETF to be put into our portfolios because of a development in markets. an example of this from a while ago was when the Eurozone started to become more volatile, and we decided that we needed a way to diversify rather than just owning all of Europe. We needed to examine individual country holdings as well, not as a bet on one individual country outperforming the rest of the Eurozone, but as a way to say, as a strategic manager where we're trying to neither bet for or against a certain market, but recognizing that now events have caused a disproportionate amount of risk to appear in this one part of our portfolio, how can we diversify some of that risk away to have a more reliable portfolio? And that was the reason why we added the Switzerland iShares ETF into our portfolio at the time.
And speaking of Europe, with that whole issue that they've been having over the last couple of years in terms of the currency being very volatile, did that make you guys look towards some of the currency hedged ETFs that are out there for exposure in a way that you might not have in previous years?
We've looked into currency hedged things, and actually many of us have a background as a quantitative international manager. And currency hedging is a bit of a issue for us because if you're trying to capture global economic growth, the growth of an economy is captured both in the equity markets of that economy and in the currency of that economy. And so actually from a very high-level perspective, hedging a currency could actually add risk to a portfolio in terms of what you're trying to do rather than take it away. And the additional costs associated with currency hedged ETFs and tax implications also tended to have us shy away from them. Not that we would never do it, but we don't think it's appropriate at this time in our portfolios.
Yeah, and let's talk about some of the portfolios you have over at newfrontieradvisors.com. It looks like there's 6 different risk level ones. Is there one that you're seeing that's more popular than others these days, or is there one you guys are more focused on and seeing more interest in? Anything along those lines?
Well, we love them all. We actually have what I call the mom test.
You love all the children equally?
Yes, which is would I tell my mom to invest all of her grandchildren's money in any one of these portfolios? And maybe it wouldn't be appropriate. Maybe it should be more conservative or more aggressive. But each one of our portfolios is designed to pass that test. So we have standard portfolios, which are really total return portfolios, which are not paying attention to taxes. We have tax-sensitive portfolios, and then we have multi-asset income portfolios, which are oriented for an investor who's not just concerned about the change of their wealth before or after taxes, but actually concerned about how reliable is the income that they can generate from a portfolio, and is that going to be growing over time. And so I really like these multi-asset income portfolios because it's showing what else a optimizer can do. Each of these 3 strategies has a number of different risk targets. The middle risk targets tend to be slightly more popular. I think that's always true. People always like to pick the middle one, but they've all performed quite well over time. And every portfolio that we've ever launched that's ever had $1 invested in it is still up and running. So we're quite pleased with them.
Yeah, and do you see a lot of changes coming to the tax-sensitive portfolios if we do see a big shift in the taxation situation here in the United States?
Yeah, that would, of course, require some adjustments. It's always been a way of, we've had a process where we can measure marginal tax rates and invest accordingly. This is another benefit of optimization, where in many tax-sensitive portfolios, the way they are made tax-sensitive is by simply swapping out the treasuries and the corporate bonds and swapping in municipal bonds. And actually, what we do is we measure the impact of taxes on a high marginal tax rate investor and let the optimizer decide how much they should be focusing on municipal bonds versus is there something that's still important to be gotten from taking a little bit of credit risk, or do they need to be even more conservative and worried about some of the extra risks in municipal bonds, and maybe for a very conservative portfolio have a little bit of short-term treasuries in there as well.
Okay. Well, Robert, thanks for coming on for this great discussion on portfolios. Great to have you here.
Thank you.
All right, everyone, that was Robert Michaud of New Frontier Advisors. You can check out more about their Michaud optimization at newfrontieradvisors.com. They have plenty of portfolio information too, so go on over there for additional insights on this topic. Well, hope you enjoyed this edition of the Duchamp Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, Make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Dutram Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment on Facebook too. Be on the lookout for a new edition of the Dutram Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutram.